What is bookkeeping and why it matters? Bookkeeping tracks all the financial transactions of a business, every bit of money that comes in, like sales, and every bit that goes out, like payments for rent, bills, and other expenses. It helps us see clearly how the business is performing and where the money is going. For example, a coffee shop records its sales as income. It also pays for rent, utility bills, staff wages and salaries, business insurance, and other daily expenses. The coffee shop owns assets such as cash, property, plant and equipment, and furniture and fixtures. It may also owe money, for example, bank loans, taxes, or unpaid bills. Bookkeeping and accounting. They sound similar, right? But they actually do two different jobs, and both are equally important. Bookkeeping is all about collecting and recording financial data, basically keeping a detailed record of everything that happens in the business financially. So every time the business earns money, pays bills, buys stock, or spends cash, the bookkeeper writes it down. Think of them as the record keepers. They make sure every transaction is captured accurately and in order. Once all that data has been recorded, the accountant analyses and interprets it to make sense of the numbers. They look at the records, prepare financial statements like the profit and loss account and balance sheet, and then use that information to help make decisions. Together, they give us the complete financial picture of the business. In other words, they answer the question, what do these numbers actually tell us about the business? In this lesson, we're going to look at 4 really important accounting terms: assets, liabilities, income, and expenses. Let's start with assets. These are things the business owns, like cash in the bank, property, computers, or equipment. Basically, anything that has value and helps the business run. Next, we have liabilities. These are the things the business owes. Money that needs to be paid back. It could be loans, unpaid bills, or credit card balances. Then we come to income. This is money coming into the business, usually from selling goods or providing services. We often use words like sales, income, earnings, or revenue to mean the same thing. So, think of income, sales, earnings, and revenue as 4 ways of describing the money the business earns from what it does. And finally, expenses. These are the costs of running the business, things like rent, utilities, cleaning, insurance, staff wages and salaries, and so on. So, if our bakery buys flour for £50, that's an expense, and when it sells bread for £200, that's income. By keeping track of these 4 categories, what the business owns, owes, earns, and spends, we can clearly see how the business is doing. In this lesson, we're going to look at owner's capital and the balance sheet basics. Let's start with something simple. Imagine you're starting your own small bakery. You put in £3,000 of your own money to buy equipment and ingredients. That money you invested is called owner's capital. It's the amount the owner puts into the business to get it started or keep it running. Now, as soon as the business starts, we can describe what it owns and what it owes. That's where the balance sheet comes in. The balance sheet shows 3 things: what the business owns, called assets, what it owes, called liabilities, and the part that belongs to the owner. That's the owner's capital. These 3 always stay in balance, and we show it as a simple equation. Assets equals liabilities plus owner's capital. For example, if your bakery owns £5,000 worth of assets and owes £2,000 in loans, the remaining £3,000 belongs to the owner. That's your capital. So remember, the balance sheet is called a balance sheet because both sides always have to equal each other. It's like a set of scales. When one side changes, something must change on the other side too. Every business tells a story, and that story is written in numbers. In this lesson, we're going to learn one of the most important stories: how a business earns a profit or makes a loss. Your income is what you earn, the money that comes in. Your expenses are what you spend, the money that goes out. If your income is greater than your expenses, you make a profit. If your expenses are higher, you make a loss. Here's a bakery that sold bread worth £1,000. That's their income. They spent £700 on flour, rent and wages. Those are expenses. So £1,000 minus £700 equals £300. That's their profit. What's left after all costs are covered? Now look at this case. They earned only £600, but their expenses were £800. So £600 minus £800 gives us minus £200. That's a loss. They spent more than they earned. This is exactly what happens in every business, from a small cafe to a big company. If you manage your income and expenses carefully, you'll make a profit. But if your expenses get out of control, you'll make a loss. So remember, profit isn't just a lucky number. It tells you how well the business is being managed. Profit means your business is healthy. Loss means something needs fixing. Every time a business does something, buys, sells, pays, borrows or earns, it affects two parts of its accounts. That's called the dual impact or duality principle. It's the rule that keeps our books balanced and is the heart of double-entry bookkeeping. The accounting equation is the foundation of all bookkeeping. It shows that everything a business owns, assets, is financed by either what it owes, liabilities, or what the owner invested, owner's capital. Accounting equation formula: assets equals liabilities plus owner's capital. This means the two sides of the equation must always stay in balance. Let's say the owner puts £5,000 of their own money into the business. What happens? The business receives cash, so assets go up by £5,000. At the same time, the owner's investment increases, so capital goes up by £5,000. See, both sides of the equation increased equally. Next, imagine the business buys a computer worth £1,000 but doesn't pay immediately. The business now owns a new asset, the computer. So assets go up by £1,000, but it also owes £1,000 to the supplier. So liabilities go up by the same amount. The equation still balances. Now, the business pays off £500 from a loan. That means cash goes down. So assets decrease by £500. The amount owed also goes down. So liabilities decrease by £500. Again, both sides fall equally, and the balance is maintained. Next, the business earns £2,000 from sales. That means cash increases. Assets go up by £2,000. At the same time, profit increases the owner's share, so capital goes up by £2,000. The business is growing, but the balance still holds true. Finally, the business pays £300 for rent. Cash decreases, so assets go down by £300. That rent is an expense, which reduces profit, so capital goes down by £300. Both sides decrease, and the equation stays equal. So, in every example, something goes up and something else goes down. That's why the accounting equation always stays balanced. Every transaction affects two accounts, but the total always matches. That's the magic of double-entry bookkeeping.
मेरी फैमिली ने चाहिए रैकलीन शेव बंदा तू तो डॉगी नहीं कटंदा जमा डाकू लागे से
होरे हाथा पे भी होके गे निशान मेरी जान मखा 2.5-3 लाख का तमाकू लागे से
वो तेरा दूं के परी